On the economic front this year, soaring inflation and high interest rates have been making headlines across the globe as countries seek to ease the cost of living amid the prolonged pandemic and Russia's invasion of Ukraine. So what have been the broader implications of efforts to ease inflation? How are pundits explaining Korea's first projected trade deficit in 14 years? Also, are Korea's concerns over the U.S. Inflation Reduction Act being addressed? Welcome to Issues and Insiders. Today we address the economic headlines for this year as the world continues to weather the consequences of COVID-19 and the violent conflict in Ukraine. For more, I have Professor Yang Jun-sok from the Catholic University of Korea. Professor Yang, it's been a while. Welcome back.
Happy to be here.
I also have Professor Lee Mun-seob at the University of California, San Diego, live on the line. Professor Lee, it's a pleasure to have you with us.
Thanks for having me.
Right, Professor Yang, we'll start here then. Korea's inflation hit a 24-year high back in July to stand at 6.3%. Now, authorities say that this year inflation will hover on 5.1% range and then fall to 3.6%, I believe, next year. Do you share this outlook?
Well, the numbers will be slightly different, but in general pattern, I do think that that is the correct path that we'll take. I do think that the Korean inflation has hit a peak. If we look at the biggest causes for the inflation, it was the bottleneck from the pandemic as well as the invasion into Ukraine, which raised oil and food prices. Both of those are being alleviated. The oil prices, after going as high as $120 per barrel, it's now slightly below $80 per barrel, and it seems to have stabilized there. Commodities and food prices have fallen also. So, and if you look at the other contributing factors, then the most recent Korean survey shows that inflationary expectations are now 3.8%. That's down 0.3 percentage point from last month. So inflationary expectations are falling as well, though still high. And the wage data, it shows a growth of 5.1% over the last 12 months. That is still very high, but it does seem to be shrinking very slowly. And Korean won also has stabilized after going up to over 1,400 level during the fall. So we still have very high inflation, but it's on a downward path. I think it will take a very long time to completely fall to the Bank of Korea goal of 2%, but I think we have hit the peak.
Right, I see. And Professor, as part of efforts to tame inflation, the Bank of Korea has been aggressively raising its interest rates despite fears of a recession. That being said, what have been the broader implications of the central bank's tightening of its monetary policy, do you think?
So this year, the Bank of Korea increased its policy rate from 1% to 3.25%. So it was necessary due to the high inflation we just discussed. But at the same time, it was painful. So we have seen the instant reactions in the financial and housing markets, represented by the decrease in the stock market prices and housing prices. The next year, so we will see more reactions from the labor and the output markets. This is because it takes time for the companies to change its investment decision and for consumers to change its consumption behavior after seeing this increase in the interest rate. So, but again, it is the necessary cost we need to pay to tame inflation by reducing the aggregate demand.
Right, and staying with the response to these high interest rates, which have been burdening those with mortgages, especially amid the plunging prices of homes, Professor Yang. Now, authorities have vowed to ensure a soft landing for the housing market here. Is this possible?
Okay, well, we should take a look at first whether it is possible, and then secondly, whether it is desirable. But tackling the problem of whether it's possible first, Korea is not in complete control over its interest rate. Professor Lee sort of implied this, but one of the reasons why Korea has to raise its interest rate so quickly, it's mostly to deal with Korean inflation, but also because the U.S. is raising their rates. We cannot, right now the U.S. rates are higher than Korean rates, so there is an interest rate reversal, and we don't want that gap to grow so quickly. Now, because Korean economy is not in a good a shape as the United States, we can't really follow the U.S. rate increases one by one, but we should make sure that we're basically on the same trend so the gap does not grow as much as possible. And right now, the U.S. has said that they will raise the rates. In fact, they're raising the rates more than what they signaled during the fall of last year. And they're now signaling that they'll probably raise the rates through the first half of next year. So Korea will probably raise interest rates as well, not as quickly, but probably will keep raising its interest rate until the U.S. stops raising it. But then the U.S. also has signaled that they will keep the rates high until at least the end of 2023. That means Korea cannot really lower our interest rate either until U.S. starts to lower theirs. So we do not have complete control over our interest rate, and we may have to raise it even more. So that's going to make it very hard to have a soft landing in the real estate and housing industries. Having said that, though, is it really desirable to have a soft landing here? Well, for the sake of financial sector security, for the sake of some of the borrowers who may have overextended themselves, yes, it is better to have a soft landing. But my concern is that if they put too much attention on having a soft landing, that will give more impression that housing is a very safe investment. If the prices of housing goes down too much, government will step in and control the price of housing. I think that was one of the factors why people have this idea that the housing investment is safe, and it caused overinvestment into housing price bubbles that we saw for the last couple of years. And if the government follows the same old policy path of not letting the prices go down too much again, then the next time there's a reason for housing prices to rise, people will get on the bandwagon even faster and even more than what they did in the last 2 years, and we will see even a worse bubble, and it'll be harder to control the bubble the next time. I think there is an argument to be made that perhaps we should let the housing prices fall more than what could be considered prudent, just to make sure that people know that this is a risky investment.
Right, I see. Meanwhile, against that backdrop, Professor Lee, perhaps further complicating efforts to ease inflation is the sharp surrender of the Korean currency, the won, against the U.S. greenback, which is something that Professor Yang mentioned earlier. Now, the won has weakened some 9% against the dollar thus far. What are your prospects, Professor Lee, with regard to the exchange rate going forward?
So during this year, the U.S. policy rate has been always around the 1 percentage point higher than the Bank of Korea's policy rate. So this interest rate, the difference between the two countries that generated the capital outflow from Korea to the U.S. and naturally the devaluation of the Korean currency against the U.S. dollars. The Korean monetary policy, has been quite well synchronized to the U.S. monetary policy decision so far. So given this, the synchronization for the next few months, so I think it's unlikely to see the huge increase or decrease in the exchange rates. But I share exactly the same concerns with Professor Yang. So if the Korea has the certain reason not to follow the U.S. the monetary policy decision, the increasing the interest rate due to, say, the huge housing debt and so on, so then the interest rate gap between two countries would be widened, and the currency could be even further devalued.
Right, I see. Professor Yang, Korea, it's also forecast to post its first annual trade deficit this year since 2008. Could you explain this dismal reality for us? And do you share And do share with us your thoughts for the new year.
Okay, well, it's been sort of overwhelmed by the news of trade deficit, but Korea actually has the best export year ever. If you look at the merchandise export for January to November, it's $629 billion. That's higher than every year except last year. So right now, the betting is that if the December's number comes in, we will have the highest export, at least in terms of value, than Korea ever had. But the reason that we have a trade deficit is obviously because imports went up much faster than exports, and the main culprit of that is oil, energy, and food prices, as well as some commodity prices like some metals. But as I mentioned before, that has been stabilized somewhat in the last few months. What has been a problem is that our exports to China has gone down. A lot of people wonder whether this is part of a long-term trend. We did not expect Korea to maintain a trade surplus with China forever, but we did expect it to be a lot longer than this. Some people are seeing this as an indication of that long-term trend coming in early, but personally I think it's more because China had factory shutdowns and lockdowns because of the coronavirus that stopped production, and because most of what Korea exports to China are intermediate goods, that affected our exports. So that's two culprits for the trade deficit. Now, do I expect a trade deficit next year? Probably not, and that's because China has given up its zero COVID policy, though there is some question there because the corona infection has gone up so much, they may still have to shut down production anyway. And then secondly, as I said, the prices of oil, energy, commodities has been stabilized, so I do expect trade surplus next year, but I also suspect that it'll be what we call a recessionary surplus. That is, the actual values of exports and imports will fall, but value of imports will fall more, so we will have a trade surplus. And the reason that I think it's going to be a recessionary surplus is that, first, one of the reasons why we had such a good year for exports this year is because of global inflation. Because of the global inflation, the prices of Korean exports, especially petroleum-related products, had been sky high, so that added to the value of increase in exports. Not necessarily the volume, but value went up considerably, and that's not going to be around next year. Also, there will be a general global slowdown in trade. Usually in the past, when you had a slowdown in the growth rate of trade, Korea was fairly consistent in following that trend. So Korean exports and imports, I think, are going to fall in terms of value. But what we've seen in the past was that when we have a situation like this, we do end up with a trade surplus. It's just that the value of both exports and imports are going to be less than this year.
Right, I see. Professor Lee, staying with trade, officials here are hoping for concrete measures by the Biden administration to address Korea's concerns with regard to the U.S. Inflation Reduction Act, which excludes tax credits for electric vehicles assembled outside of America. Do you foresee a favorable agreement with regard to these concerns?
The Biden administration here in the U.S. is promoting so-called the inshoring, the moving the business operations from overseas back to the home country. So the excluding the tax credits for the EVs assembled outside the US would make the US car makers more competitive. But it is definitely discriminatory against the non-US car manufacturers. Korea is not a single country raising a concern these days. The European Union members recently raised the concern, and they are considering to challenge it because it may be in violation of the WTO rules. Do I see the favorable agreement in the near future? I think it depends on how the US economy evolves. So I think it's less likely for now, but if the US enters into stagflation, the combination of high inflation and high unemployment rate, so then the US government will be forced to promote this, the so-called inshoring, even further. So let's see how the US economy works.
I see. We'll have to keep our fingers crossed on that then. All right, Professor, that's all the time we have for today. Thank you very much for your time and your thoughts. And Professor Yang here in the studio, thank you very much for your insights.
Thank you.
Thank you.
Right. Well, on that note, we end Thursday's edition of Issues and Insiders. Thank you for watching. See you same time tomorrow.